Good evening once again, and then welcome to another session. Like I said, what we're going to be trying to do today is just risk management. But then, before we dive into it, there are certain things I want us to look at. First of all, the whole aim of risk management. So, there's this whole thing where when we as traders are trading, you see that you have, let's say, $1,000 account, and then you just jump on a trade, and then price hits your stop loss, and then you're losing like $500. Do you understand? And then you were not even intending to, let's say, lose $500. Do you get? But then you end up losing $500, and then it becomes confusing. And then the normal reaction you'd get is to cut down your lot size. Do you understand? Cut it down to like maybe, let's say you used one lot size before, you cut it down to like 0.5. Do you understand? So that you would not lose much. And then your next trade comes, and then it's a winning trade, and then you make like 200. But then if you had used the same one lot size now, you'd have actually made like maybe $2,000 to actually cover up that your whole $500 loss. Do you understand? I know we all have been through that whole phase of like, oh, if to say I been use big lot size, I for don't cover up for that money, but then fear won't allow you. Do you understand? All those things are problems improper risk management cause. So when you don't have or when you don't practice proper risk management, you see that there's no consistency, first of all, with the losses you're taking. And then whenever you have winning trades, those winning trades are not able to cover up for those losses. So it's actually a very big problem that we as forex traders need to actually solve to actually be able to unlock that whole last part of profitability. Do you understand? After learning the whole strategies and all, risk management is that whole, it's like the topping on it. Do you understand? You have to actually know it to like do well in the market. So, first of all, there are certain things I want us to understand. First of all, is your stop loss. So, what is a stop loss? Ideally, we just say a stop loss is that whole level where you're looking at price hitting, or that whole level where you're looking at price hitting so that to close your trading like small losses. But then as we have all come to realize, a stop loss is more than that. A stop loss is actually that whole benefit of the doubt you're giving the trade. Do you understand? Whenever price gets there, it's more or less like the setup is invalid. Do you understand? So we'll close the trade and then come back later. That's the first thing I want us to look at. Then the second one, let me be writing them down so that we can know. So the first one is a stop loss. The first aspect of this thing is a stop loss. The second one, the second thing I want us to pay attention to is what a risk to reward is. Now, a risk to reward ratio, some people just call it risk reward. A risk reward ratio is more or less your stop loss compared to your take profit. So, so a risk reward is more or less your stop loss compared to your take profit. Do you understand? It's how many times your stop loss can enter inside your take profit. Do you understand? So if I have a setup like this, one sec. If I have a setup like this, let's say I'm looking to buy at this level and then my stop loss is here. You can see that the risk reward is a 2.28. Do you understand? Which means that this stop loss level here now, even by looking at it, you would see that this stop loss can enter inside this level two times. Now, what is the importance of this whole risk reward? Why is it important? It's because, let's say, if price hits my stop loss, I'll be losing, let's say, $100. Whenever price taps my take profits, I'll be looking to make times two of that, times 2.8 of that, which is going to be like 2.28 times 100 is going to be $228. Do you understand? So that's why a risk reward is important. It's important because whatever you're risking, it tells you what you're going to get. Do you understand? Now, that's the second one. Sorry, I was writing it and then it just left. So the first one was our stop loss. Second one is risk reward. Risk reward. Risk reward ratio. And then I think the last one would look at is what a lot size is. You guys already know what a lot size is. A lot size is more or less the amount of quantity you're looking to trade. Do you understand? Now, we all know what our account balance is. Now, why are we looking at all these things? Why are we not just jumping on the whole idea of risk management directly to like solve it? Do you understand? Why we're looking at all these things is because when it comes to doing proper risk management in the market, these are things we have to pay attention to. Do you understand? These are like important things we have to like take note of to be able to do proper risk management in the market. So one might ask, what's the whole idea of risk management? The whole idea of risk management for me personally, I think I would have saved this till the end of the session to like talk about it. But then for me, it's more or less looking to partition your accounts or looking to like break your accounts into bits. Do you understand? Let's say I have a $1,000 account. I'll look to like break it into bits. First of all, why? Because it's not every trade that is a winning trade. So I'm breaking it into bits so that whenever I have a losing trade, I don't lose all my money. Do you understand? And then whenever I have a winning trade, I'm able to cover up for at least one, two losses and then make extra money on it. Do you understand? That's the whole essence of risk management. It's preserving our account in losing times and then making us money in winning times. I think that's the whole idea of risk management. Now, how do we do this? A lot of us already know that. Or there's this whole simple way that people do risk management where they're like, oh, I'm not going to risk more than 20 pips stop loss. So I'll use 0.2 lot size with my account, 20 pips with 0.2 lot size. I think that's like $40. Let's say I have a $200 account. So every trade is going to be $40 loss. Do you understand? But then where the problem starts coming out is where, let's say I have a setup and then the setup is more than 20 pips. Do you understand? What do you do? You have setups that the stop loss will be less than, if you follow the whole strategy, your stop loss is supposed to be less than 20 pips. But then because you've already conditioned yourself to risk 20 pips, you still have a wide stop loss. I don't know if you guys are getting what I'm saying. So personally, I normally advise guys that, okay, if the whole rigid stop loss of 20 pips, 10 pips, 15 pips is working for you, stick to it. But then make sure that you're sticking to it, like you're following it religiously. It's not the one that today you do it, tomorrow you jump and go and do another one. Do you understand? Aside that, the other thing you can do is have a flexible stop loss. So this is when you're setting your stop loss based off of the strategy. Do you understand? So if I like plot my Fibonacci retracement tool here, if I plus my Fibonacci retracement tool here, you'd see that the stop loss, if I okay, sorry guys, my network is really, really bad this night, and I don't want to postpone. So those that'll be watching this video later, it's network that went off. So let's continue. I don't know. Were you guys getting me before we went off? I don't know if you guys were following. Please, if you're following,
Yes, sir.
that section so that I know you guys were getting me. So we're talking about having a flexible stop loss. We're talking about having a flexible stop loss, and I was telling you guys that. Let's say I use my Fibonacci retracement tool here. You can see that the stop loss here is 7.5 pips. And then my target is more or less 21 pips. It's like a 2.81 risk reward. Now, this same Fibonacci that I used there, let's say we jump on another currency pair. Let's say we jump on NZD. Okay, yeah, let's jump on NZD USD and then use FIB and then let's see how many pips. Remember, AED USD is 7 point something. Okay, good. So this is NZD USD. Let's use the same Fibonacci tool from the low to the high. And then our host entry at 0.618, stop loss a few pips below 0.79, and then we're targeting the zero. You can see that the risk reward here is 2.56. And then our stop loss, you see that our stop loss is bigger here. It's an 8.7 pip stop loss. Do you understand? So how do I trade, or how do I enter trades with different stop loss levels and then have or risk the same amount? So let me outline the problem for you guys. So let's say we have a $1,000 account. We have a $1,000 account. And then the amount I intend to risk per trade is, let's say, $50. That's risk per trade. per trade. So risk per trade. Risk per trade is $50. Do you understand? Now the question now becomes, how do I achieve this if I have a flexible stop loss? So normal, my stop loss now using Fibonacci, I cannot go and work out and change it and say, oh, because I'm used to using a 20 pip stop loss, then I should extend it to 20 pips. No, my stop loss is not something I can change. It's based off of the strategy. Do you understand? So I cannot change my stop loss. So for this trade now, we have an 8.1 pip stop loss. So what can I change in this equation to like achieve it? The answer is your lot size. Do you understand? Your lot size is what you can change. And then the question now becomes, how do I know which lot size I will use with an 8.1 pip stop loss to achieve a $50 risk? Do you understand? That question now is answered by risk calculators. So I know most of you have heard what risk calculators are, and we have a lot of them out there. Do you understand? But then personally, the one I recommend is either Nash Markets or Stino. So Nash Markets, Nash Markets, or Stino. So Stino is paid. I think currently, oh, shit. Currently, Stino is it should be around 14 or $20 a year. I think so. And then Nash Markets is free. So we're going to look at both apps. We're going to look at how to use them and how they basically help us know what to do. So one sec. Um, Let me share my phone screen and then we'll look at both apps. So important things for us to notice: we have a $1,000 account and we're looking to risk $50 per trade. And then we have, in this case, we have an 8.1 pip stop loss. So let me share my phone screen. Can you all see my phone screen?
Yes, sir.
Okay, good. So now if you look, you'd see that we have look at it here, look at Stino and then look at Nash Markets. So we start with Stino. Stino is actually very, very simple. That's why I like it. So first of all, you're going to input your account balance in dollars, which is $1,000. Do you understand? Now my risk is set to percentage. There are certain things you would actually have to change to actually have something like this. Yeah. So the first one is go to your settings and then you change your risk, change it. If you want to be putting the amount, in this case, now I want to put the amount, which is $50, you put the amount. And then position, change it from units to lots. So we go back. Our risk is $50. And then our stop loss is 8 points something. I think it's like 8.2 pips. Do you understand? So these are the things we need to input. The next thing is we'll press the arrow beside it and then choose the currency pair. The currency pair we're looking at in this case is NZD USD. You tap on NZD USD and then you click on calculate. So now look at this. It's giving us a lot size here that with 8.2 pip stop loss, we should use a 0.610 lot size. That's 0.61 lot size. So if we use this whole 0.61 lot size now, once price tap our stop loss, we'll be losing $50. Do you understand? We'll be losing $50, which is 5% of our $1,000 account. Do you understand? So like this now, we've gotten the lot size to use for this trade. I don't know if you guys get the idea. So it's quite simple. What you just need to input is your account balance, your risk, and then your stop loss in pips. Do you get? So this is how you keep a uniform stop loss, even though you're having different stop loss levels. So this is how you keep a uniform risk, even though you're having different stop loss levels. It's by using this whole risk calculator. Now let's look at how to use Nash Markets. So we go to Nash Markets. Now, the first thing we need to input in Nash Markets is our account balance. Same thing, it's a $1,000 account. Don't touch the leverage, leave the leverage at what it is. Risk percentage, since the percentage is 5%, but then it's the amount that we came here with. So you just put amounts and then it will calculate the percentage for you automatically. The next thing you need to do is select instruments, which is the currency pair. Now, NZD is already my favorite here, so I'm going to tap on it. And then we have to choose whether it's a buy or a sell. In this case, it was actually a buy. So we'll click on long. Now it's giving us the current price of NZD USD. If it's not your entry price, you can change it and then put what your entry price is. Do you understand? Now, if you look at this, you see that we have stop loss price, stop loss pips. You don't have to put both of them. You can just put one and then to calculate it for you. So stop loss pips now is 8.2. Do you understand? It has given me the price by itself automatically. And I think the take profits was roughly around 20 something pips. Let's just say it was 25 pips. Do you understand? Now, what I need to do next is click on calculate. Once I click on calculate, it's going to bring me to this page here. So now I have instruments, which is NZD asset class Forex, direction long, that's a buy. You can see that the position size is still the same thing. That's the lot size is 0.61. So if I use this 0.61 lot size and then price hits my stop loss, I'm going to lose $50, which is 5% of my account. But then if it hits my take profits, I'm going to make $152. Do you understand? So my risk reward is what? A 3.0. All these other ones are just extra informations. Comments, excellent risk reward on this position. So you can see that using this tool now, we have a flexible stop loss, but then we're going to be having uniform losses. So let's say my next trade now, I have like a 20 pip stop loss. I'll just come to this stop loss in pips and then change it to 20 pips. And then my take profit was like 50 pips. After I finish putting it, I'll click on calculate. And then it will give me the lot size that I'll use. You see what? 0.25. See that it has cut down the lot size. So if I use a 0.25 lot size now, if price hits my take profit, sorry, my stop loss, I'll lose $50 still. If it hits my take profit, I'll be making what? $125. See that it's still the same thing. Do you guys understand?
Yes, sir.
Yes, yes.
So this is how you keep a uniform.
Yeah, we do.
Do you understand? You see that it's not just one thing, it's a couple of things put together. Like I told you guys, why is this whole thing important? It's because inside this our $1,000 account now, if we have 1, 2, 3 losing trades, if we just have one winning trade, you see that it will cover up for what? At least 2 of them or even 3 of them. If you have like a 3 risk reward. Do you get? Now, one thing you'd see that a lot of people would always be asking is, how do I know which amount to risk? Because honestly, you have to find that sweet spot where you're not risking too much. At the same time, you're not risking too small so that you make something substantial on your account. I think people that have this problem the most is people that do prop firms. You see a lot that someone is trying to like trade a prop firm account and he's risking, let's say, 0.5% and he's having just 1, 2, 3 trades, 1, 2 trades a week. And then you see that after a month, he has not made anything. So you have to find that sweet spot. So there are key things that determine which amount we should risk. And the first one for me is risk that amount where once you take your trade, you're not panicking. I think I was telling my students at the trading floor earlier this week that the reason why you trade a demo account and then you don't panic, or sorry, you make money on it, is that absence of fear. You don't have anything to lose. So you can try to replicate that also by using risk management. So you risk an amount that you're not tensed. Do you understand? So inside $1,000, I can comfortably risk $50. I would need to take 20 losses before I would lose that account. Do you understand? If $50 is too much for you, cut it down to $30 or to 25 up until you're comfortable. You're risking it and then you're not like running helter-skelter. Do you understand? I think that's one thing you need to consider. The second thing you need to consider to know which amount to risk is how many trades you're taking in a day or in a week. Do you understand? Or even in a month. Sometimes there are some bad months that personally I take just 4 good trades. Especially months like January, February, March, April. All those months are very ugly months that most times I will not really get trades. So in those cases now, I cannot say I'm trading a $1,000 account and then I'm risking $50. I want to take my risk up a notch to maybe $100 because I know that I'm not having much. Do you understand? But then in situations where I'm having a lot of trades, let's say I'm having 5 trades a week, then I have to cut it down. Do you understand? So if I risk, let's say $100 per trade, and then I'm having like 5 trades a day, it means if I
What
take,
happened?
please, the noise. That means if I take
Go.
5 losses in a day, I'm losing $500, which is like half of the account, which is not good. Do you understand? So you need to take account of how many trades you're taking. Do you understand? And then another thing you still need to account for is how many losses you get. You need to understand all these statistics. On average, how many losses do you take? If I take 10 trades, how many wins do I get? How many losses do I get? Those are the things that will determine how much you'd be risking. I don't know if you guys get what I'm saying. And at the same time, you still need to consider your risk. Do you understand? Because your risk reward ratio now is what will determine how much you'll be making whenever I have a winning trade. So if you're having a risk reward ratio of 1 to, that's you risk $100 is $100 you make. For me, I feel it's not good, but then it's some people actually do it, which if it was fail fine. Do you understand? But then these are things you still need to consider. Do you get? That's been said, it's more or less everything I have at the top of my head right now to talk about risk management. Do you understand? There are certain things we still need to consider, but then it's the more you're engaging with the market that you get to see them. Do you understand? And one thing I always advise guys is that whenever you observe something or whenever you see a problem you're having, please reach out to me. Let me solve it. Do you understand? So that's those of you that joined late, I'll be uploading this video later in the evening, and then I'll send it to you guys. I'll send the link to you guys. So just watch out on all the mediums that you got this link to join this meeting for the link to the video. And then what again? If you don't want to miss any of our sessions, I'll drop the link to the group chat so you can join. Okay, someone said, yes, I have this problem too. So the take profit is also, no, your take profit is not called your risk reward. It's how much your stop loss is compared to your take profit that is called the risk reward. So one sec, let me send the link to the group. So those of you that are not need to join, and let's copy link. So I just pasted the link.